Welcome to Market Overtime. I'm Oliver Rennick. You're watching the Schwab Network, and today my guest is a former bond fund manager at ING Deutschland and the current author of the Macro Compass, a newsletter, a very popular Twitter, and as I understand it, Alfonso Peccatiello in the midst of building his own hedge fund. It's my first time speaking with Alf, but I've read a lot of his work. He's got a very interesting macro perspective. Alfonso, thank you so much for being here with us on the Schwab Network.
It's a pleasure, Oliver. Thanks for inviting me.
Appreciate that. So let's kind of start with the now. We came into this year expecting a bunch of rate cuts. Growth didn't surprise to the upside. But in the last week, investors have flipped kind of back into this hope that there's a Fed put. So kind of start me off with where you fall along that line when we think about the risk of inflation or reflation versus the risk of a recession or deflation. Do you side on one part of that scale?
I would say when it comes to market pricing for a macro investor, listen to the game masters is what I would say. And the game master in this case is the Federal Reserve, right? I mean, you have had a quarter of hotter than expected core inflation, hotter than expected wage growth, real GDP growth and real retail sales are holding up okay. And nevertheless, you go at the press conference after a full quarter of this data and you hear Powell being asked questions about hikes, answering like, hikes? What do you mean? We're only waiting for the moment when to start cutting. So then you understand that the bias that the Federal Reserve has is very, very clear. And the reaction function is also very, very skewed towards a dovish outcome, right? So effectively, you're looking at a situation where the Federal Reserve is looking at cutting, only about when to start cutting and at what pace to start cutting. But that's the only side of the distribution they're interested in. And so when it comes to market pricing across asset classes, basically they're cutting away all the uncertainty they can at this stage by shrinking how wide the possible future outcomes are. You only have to look at cuts going forward. That's important for a macro investor.
How much of that shift from a literal handful of cuts, upwards of 6 to 7 being priced coming into this year, versus now the one cut, basically, give or take, as we're doing this interview for 2024. How much of that drop in the expectations for cuts came from data? How much came from the language from the Fed, as it seems like you would argue they are steering us more towards the dovish side?
So that's a great question, Oliver, and the answer is from data mostly. And I want also to clarify something for our listeners. You have to try and look at probabilities rather than at just one number, at the distribution of probabilities in particular. And what I mean is the following. In January, when you were looking at 6 or 7 cuts, what you were actually looking at was a distribution that had as the most likely outcome 3 cuts. That was in January. But then it had a very fat recessionary tail still attached to it. People really didn't want to go away and give away that recessionary tail. And so that fat tail made it so that the pricing you saw on the screen was for 6 or 7 cuts. But the most expected outcome out of the option pricing of the bond market was still 3 cuts with a fat recessionary tail. That was the situation. Today, what has happened is that the model outcome, the most expected outcome is 1 to 2 cuts. That's where we are today. But importantly, most of that repricing, Oliver, has come from data denying over and over and over again this idea we're going to have a recession anytime soon. And so that fat recessionary tail has been completely priced away, almost completely priced away. Right now, option implied probabilities for a year out under my models are pricing a US recession as an 8% probability. 8%. That's pretty low. At the beginning of the year, we were at 26%. Under that metric. So that has been most of the bond market repricing, pricing away that fat tail we're going to have a recession. The bond market doesn't believe that anymore.
Take me through that model. How do you arrive at that figure?
So what you can do there is look at the options that are underlying the SOFR future contracts. So for example, if you want to go a year out, what you do is you take right now the SOFR, let me look at the calendar, H5 contract. So that will be about maturing in March or April next year. So you're looking at the next 12 months of action from the Federal Reserve that is effectively embedded under their SOFR contract. So that's the future. What you want to look at is the options that are underlying this future contract. And you want to basically build strikes of that options so that you can identify a certain particular outcome that only comes off if effectively the Federal Reserve ends up, for example, cutting 5 times or 4 times or 3 times or 2 times. So literally through options and through different strikes, you can build a probability distribution of what any potential outcome will be in the future according to how options are priced today. When you build that distribution, you basically derive all the possible outcomes that option traders are pricing that all converge into the single pricing in the screen that you're looking at when you look at 2-year rates or 5-year rates or 10-year rates. But the beautiful thing is, in this case, it's not one price, it's a distribution. And today, the distribution interestingly says, hey, we expect the Fed to cut once or twice in 12 months from now. We even expect the Fed with a 20% probability to hike going forward. So people don't want to really believe what Powell said at the press conference, that the Fed is not going to hike at all. But then importantly, the biggest shift has been that this recessionary tail has been priced away really aggressively from January to today.
I think it's a very good way to describe how that shift happened the last 5 months, pricing down or maybe fully out the recessionary probabilities. However, if we do define our recession probabilities tied to rates or overnight rates, does that leave us open to vulnerabilities if a recession occurs but they can't cut? If we derive recession odds from rate expectations, is there a scenario where recession occurs but they can't cut rates?
You're basically hitting macro investing to the core, because at the end of the day, how you make money in macro is not necessarily by being right. You make money in macro by having a view that deviates from consensus pricing, so an out of consensus view, and then when the distribution of probabilities shifts your way, when consensus moves towards you and you are out of consensus first. That's where you make the most money in macro. And today, what we are looking at, Oliver, is indeed the bond market pricing in an 8% probability of a recession over the next 12 months and a strong model case scenario that the Fed is going to cut once or twice in 12 months. That is the pricing that you are investing against. That is the consensus that is built in cross-asset market pricing. I'm going to add on top of it that if you look at more standard economist consensus, the average US economist is looking at US GDP growth in nominal terms, so real GDP and core inflation by the end of the year, to be north of 5%. For your reference, that would be the longest 5% plus nominal growth period in the United States since 2006. So you're looking at a very rosy consensus out there, okay, when it comes to nominal growth. You're looking at the bond market pricing a very small probability of a recession over the next 12 months. So you need to ask yourself, if your view right now is, I want to make money in stocks, for example, because a recession isn't going to happen, then I have a bad news for you, because that's already priced. You need to have an out of consensus view here to try and monetize. Obviously, the most out of consensus right here is exactly to play on a recession, because people have been expecting that for 18, 24 months even at some point right now, and they're throwing in the towel.
To your point, it wasn't necessarily out of consensus to bet on recession last year. At many points, it seemed like it was in consensus. So many data points seemed to point that way, and then anyone who positioned that way got burned. So if you view the rate of, if you view the odds of a recession now being priced very low, Alfonso, does that essentially mean that your view right now is betting on recession? What is kind of the strategy as you're building out? I understand you're starting a macro hedge fund. Is that the core view that we will have a major slowdown? Take me through kind of the timeline for how we might see that unfold.
So right now, this is going to sound pretty funny, but what I'm playing for the last 3 weeks is the stock market to go, the S&P 500, to go north of 5,200, which basically we are hitting today already. The idea there, I mean, it's funny to think that if I expect, and I do expect, nominal growth to underperform analyst consensus, so not to print at 5% in nominal terms by the end of the year, but lower, if you expect that, why would you want to be long stocks? Well, it's pretty simple. If you expect that, and if you hear Powell telling you that at the first very sign, Oliver, of labor market weakness, he will freak out and come in and cut rates, because that's exactly what he told us at the press conference, then you know that as long as nominal growth underperforms, but it's not recessionary yet, there is going to be a Fed put. There is going to be effectively a big Dovish shift by the Federal Reserve, and stock markets tend to like that. You know, when you're not deteriorating aggressively, when you're not in a recessionary environment, and you have a Fed put, that's possibly the best possible outcome for stock markets out there. And that's that normalization, that cutting away uncertainty, having a new Fed put basically in town has led me to want to be tactically long stocks. Now, there will be a point, I believe, if I'm right on the nominal growth slowdown thesis, where that slowdown in nominal growth can turn into something a bit more scary, okay? And that is the tipping point. But the tipping point might be several months or several quarters down the road. So as a macro investor, you need to be flexible. And right now you are in the part of the distribution where the Federal Reserve is cutting away any uncertainty for you, is actually being proactively dovish. And if nominal growth slows down, you are in the position where bad news is actually good news for a limited period of time.
That limited period of time is important. Looking at your notes, you call this next Fed put, or the one we might be in right now, one of the most bold versions of the Fed put. But before we get to that kind of timeline for when the Fed put doesn't work, let's talk about whether or not it exists right now, because I feel there's an opportunity there for some pushback, Alf, which is that we've seen some cracks already form in the labor market. I mean, just looking at unemployment, we're a year past the low. And the unemployment rate, it's crept up. We've seen people staying in their jobs. They're not leaving as readily. And Powell seems to keep at every moment in every press conference saying, no, I haven't moved up my targets. I'm going to get it to 2%. So when you say he's eager to cut at the first sign, have we not already had some signs of weakness and he's holding pat?
Yeah, well, I would say it needs to be, because core inflation is still at 3%, it's a bit hard for him, Oliver, to be extremely proactive. So, of course, he's trying to balance both sides of the mandates as we speak. But I find it incredibly funny that you have had a full quarter of strong GDP growth and strong inflation, and still his answer at the press conference is all focused on potential weakness in the labor market. I mean, doesn't it tell you something about where he's skewed when it comes to reacting first to what? He clearly wants to react first to weakness, then hike interest rates further. But nevertheless, the key variable, I think, to watch in the US macro cycle is something called the debt service ratio.
Okay.
So the debt service ratio is a very simple metric, and the BIS, the Bank of International Settlement, has a public database on it, so people can just go and check it live. Unfortunately, the data is lagged by 6 months, but it gives you a good indication. And the debt service ratio measures the amount of disposable income, the amount of earnings, the amount of salary, the amount of disposable income that corporates and households in the US have effectively to spend to cover interest rate costs, be them corporate borrowing costs or mortgage costs or credit card costs, whatever it is, okay? Now, that number, historically speaking, for the United States has been somewhere around 15% by the BIS methodology, 15%. Now, because the US private sector has been very, very smart in terming out debt, in locking in low interest rates between 2017 and 2021, what is happening right now is that as the Federal Reserve raises interest rates, the private sector is pretty much immune to it. There is not a lot of refinancing going on at these high interest rates, at least for the first 1 to 2 years. And so the debt service ratio does not go up because your debt servicing costs are not increasing. The pass-through from Fed hikes is very slow. But lately, over the last 2 quarters, the debt service ratio has finally started to move in the United States. And now we're getting data for Q3 2023 in June, and I expect a further deterioration in the debt service ratio in the US, telling us effectively, Oliver, that the private sector finally is starting to feel a bit of the pain coming from a refinancing cycle at higher interest rates. And the more that goes on, the more likely it is that nominal growth in the US will slow down as a result.
Now, when you look at that, it seems like a very good one because we've been able to basically keep paying down our debt. We've held our jobs. A lot of folks have talked about the amount of credit card swiping that happens on the household level, but we've got our jobs. We can pay it off and keep rolling it. Sounds like basically the metric is a way to know when people and companies can't roll it anymore. How correlated should it be to jobs, Alfonso? Should we see that number start to become problematic the more people lose their jobs, or is it more a behavioral thing where it just they overextend themselves eventually?
So think about this, Oliver. If you're a corporate, let's start from there. I mean, let's start from the employer perspective, right? If you're a corporate and so far you've been able to kick the can down the road because you don't have to refinance much of your liabilities. You know, you term them out for 10, 15 years. And so you haven't really faced this high refinancing cost that the Federal Reserve is trying to pass through. Well, did you have to fire people? No, not really, right? I mean, you can keep people on the payroll. Maybe you will slow down hiring, because when you look further, you want to reduce your potential costs when you face potential higher debt servicing costs, but you're not firing people already, right? You're just reducing your hiring. And we have seen that, right? Private sector hiring has gone down from 400K somewhere in 2022 to around 200K per month right now. But what's next step? If actually the refinancing comes in slowly but surely over the next quarter, 2 quarters, 3 quarters, a year, at some point you'll have to really literally take more of your earnings and cover your interest rate costs, right? And when you do that, what's your alternative? Well, if the economy isn't growing through the roof and your earnings are increasing, you have the same size of the pie, the earnings pie, that you need to allocate differently. Well, guess what? If interest rate costs are going to take more of the pie, then you need to cut your costs somewhere else. And then you'll be looking at shedding some labor. Like you'll be looking at the first layoffs, correct? And these layoffs ultimately will impact the household's ability to cover interest rate costs, because you don't have your secure job anymore. And then it basically becomes a snowball effect that hits the economy, because people spend less, companies do less capex, they hire less, people spend less. And finally, those are the recessionary dynamics people have been waiting for years.
So it sounds more like a death by 1,000 cuts, or sort of a slow grind down by inflation. So when does that, hopefully, I guess, if there's any positive from it, bring inflation down? Or what's the connection between that potential credit risk you're describing with today's sticky inflation? Does inflation grind us to the point where that becomes a credit risk, or are you saying there's a potential for just a credit event on its own, regardless what happens with inflation?
I mean, of course, the best possible outcome is that inflation keeps slowing down towards the 2% Fed target, so that the Federal Reserve can start cutting interest rate proactively, so that a lowest proportion of the US private sector is actually forced to refinance at higher interest rates, because the Fed is coming to cut to the rescue effectively, right? And if that happens right in time, and to be frank, Oliver, so far so good, because this inflation has been pretty rapid from the elevated levels. Were that to continue rapidly over the next 2 to 3 quarters, maybe we still have a window where the nominal growth slowdown can be, relatively shallow. But if inflation were to remain a little bit sticky, let's say for another quarter, that would effectively delay the Fed cutting cycle. That would impose another quarter of high interest rate refinancing cycle on the private sector. You are effectively increasing the odds that some of these refinancing costs get then reflected on layoffs and ultimately get reflected on household consumptions, and we finally go into a recession. So the window for a soft landing, basically, which so far has been developing pretty nicely, is still there. But right now, because the debt servicing costs are increasing, I think the Federal Reserve has to hope that the disinflationary cycle comes in pretty rapidly over the next 2 quarters. There are other countries around the world, by the way, where debt servicing costs are much higher, both in outright terms and against historical averages, than the US. So if you're looking for something to break in an economy, I would suggest there are other places that are even more vulnerable today than the US is.
Hence why they're trying to slash even quicker, bring rates down in Europe, et cetera, right? So, Alfonso, do you have, just kind of quickly to get sort of a baseline view for inflation, do you have a particularly strong view on where you think inflation is going in the next 3 months? Or are you saying, it sounds like maybe what you're saying is we're kind of trapped at this point where, to kind of put it one way, if we do end up cutting, it'll be for the wrong reasons. But in the shorter intermediate term, what do you think about inflation?
I think in the short to intermediate term, inflation, I mean, the Fed still has the tailwinds coming from the previous, let's say, housing market weakness, which normally with the lags translate into shelter inflation. We haven't seen that shelter disinflation that strongly as the Fed was expecting. If normal statistical relationship hold, then we should see that shelter disinflation coming. That's a great help for the Fed. But then medium term, let's be frank. I mean, if you're having fiscal spending to the tune and to the power and the intensity you're having fiscal spending over the last 2 years, despite an economy which is still running at below 4% unemployment rate, Oliver, it becomes very hard to have inflation back to 2% in a controllable way, because fiscal spending is nothing else than injecting new resources into the private sector. Fiscal spending is great if you use it as a counter-cyclical tool. When the economy is weakening, you accelerate on the fiscal spending side, and vice versa, you tighten your belt a bit when the economy is doing fine by itself. That's what we used to do up until 2017 and up until the pandemic. But right now, we're just throwing money at the economy regardless of the status of the economic cycle. And that's not a great recipe for a very stable and predictable inflation around 2%.
Okay, so you mentioned that in the moment right now, you're still sitting on a Fed put long stock position. But now that we're talking inflation, how do you play that view through bonds? Because it sounds like you think there's some sticky forces in inflation. But if we're going to hit a wall credit-wise soon enough, can you short bonds here?
So just to clarify, the long stock position has been held for now 2.5 weeks, and
Okay.
I'm planning actually to cut it if we go another 50 points higher.
Okay.
So 50 to 50 is my target for the S&P. I don't plan and I don't expect necessarily to see new highs in the S&P 500.
Understood.
I'll be happy with my profits there. When it comes to bond market, the story is a bit different because as long as you believe that you are going to see nominal growth coming down and weaker than consensus, then the best part to be long bonds is the short end of the curve, 2 to 5 years, because that merely reflects, Oliver, the Fed's stance on monetary policy in the short term. And if nominal growth is coming down, we have heard Powell very clearly, he will be coming in with cuts if the labor market deteriorates, right? And then you want to try and play that in the short end of the curve. For me, the most interesting play in bond markets, which people as well have failed to get right over the last 12 months, is a steepening of the yield curve. So you have heard the best investors out there, including Bill Gross and other famous bond investors, trying to call for the steepening of the yield curve the entire time, and still we've had an inverted yield curve for about almost 2 years under certain measures, right? And I think that if the labor market deteriorates, you finally get that big steepening that people have been waiting for a long time.
Okay, this is a great subject. One of my favorites. I've seen you write about this before. That is the type of steepening. In fact, I commented also when a few of the other folks like Jeff Gundlach at Double Line were talking about the steepener. They were generally thinking about a bull steepener in the past, which has basically told you recessions hitting in the moment. You invert and then you uninvert when the Fed cuts, you get the bull steepener. But then last year, they were failing to make the distinction. We were getting a bear steepener, which was reflecting all the growth on the long end. But I've seen you contest the point that the bear steepener is necessarily a positive thing. So tell me why, because it seems like so far it's been a positive thing.
Yeah, and that's been a positive thing because nominal growth has backed up the fundamental bear steepener. So, Oliver, you're totally right. The curve can steepen in two ways, bull steepening and bear steepening. What that means is that if the curve is bull steepening, it's the front end yields that are dropping like a stone and they're leading the steepening. If the curve is bear steepening instead, it's because the long end yields are going up rapidly. It's a completely different setup to steepen the curve, right? And now the bear steepening we have had, it can be good and it can be bad. Now, there is a good bear steepening, which is a bit what we have had lately. And a good bear steepening happens when nominal growth is surprising to the upside. And that's what we have seen, right? We have had a strong quarter of nominal growth. And so what the curve does is it says, oh, well, rates are high and they're reflected in the front end. But you know what? The economy can handle it. The economy is showing that it can handle higher interest rates. And so it gets reflected as well in the long end. So it's not that high rates now are leading to a deterioration in growth and inflation, which is what inverts the curve generally, but the opposite. High rates now are actually being handled pretty good by the economy. And so the curve can bear steepen. Long end yields as well can move higher. And that's the good bear steepening. The bad bear steepening instead, Oliver, is what we saw in October last year. Remember, equity markets were selling off. The bond market was really going nuts. The long end was going high, and high, 10-year rates above 5%, the curve bear steepening. That wasn't necessarily because growth was strong. That was because of term premium. That was because people weren't really happy with the fact that term premium was negative. People wanted to be rewarded for the uncertainty down the road that inflation and growth could be much more volatile. That's a different type of bear steepening, and that's negative for stocks.
Like that distinction. Hey, Alf, real quick, because we're out of time, but does that imply, if you believe the bear steepener, if the identifier that it's negative is basically term premium, and you view that that's a probability of happening, does that mean you think the auctions are going to go bad? Should we be expecting more bad auctions in the coming year?
No, I don't expect bear steepening to be, by the way, my base case. The bull steepening is what I would expect to be one play in the yield curve that could occur going forward.
Okay, so that's more of the traditional coming back to the credit rolling over. Super helpful. Okay, so basically the point is the bear steepener can be good, but it can also be bad. Hope we don't get a bad one, and basically look for credit to crunch us in a kind of more traditional bull steepening conclusion to the cycle. Very good conversation. Thank you so much for your time, Alfonso.
It's been a pleasure, Oliver. Thanks.
Thank you very much. Alfonso Peccatiello joining us here on Market Overtime on the Schwab Network. Thanks for tuning in.